Today, we still have an inverted 3-month to 10-year, even though 10s to 2s have steepened a little bit. It certainly looks like the dynamic to pay attention to is more T-bills to things like 2-year and 3-year notes. How much credit do you put in this signal, understanding that inflation has been sticky and quantitative easing has distorted some of the issues on the yield curve?
Right. I think it's definitely time to be concerned about this, although, as you mentioned, there are a lot of factors that need to be taken into consideration. I would say that one of the things to look at is whether this persists or not. In the research we've done, we use not a one-day rate or a one-day spread, but a spread, an average spread over a month or a quarter to predict recessions. And that average is the one that's predicted recessions very accurately in the past. So the fact that it turns negative 1 or 2 days is not by itself a signal of a recession, even though, as I said, it's a signal to be concerned about it.
Now, if we move under the notion that whether this is an accurate signal or not, it's going to be a signal that investors will take to heart at a time where the business cycle has certainly stretched out the runway a bit. If you were an investor watching this yield curve, debating as to what the positive or negative impact in the near term would be on the equity markets, what would you say to that investor?
Well, the equity markets, I mean, I've looked at this in the past, and the equity markets seem to react a few months after the bond markets. Bond markets seem to be the early signal. So for the stock market, judging by past experience, it doesn't necessarily mean something negative right now. Although if the signal persists and we eventually do get a recession, we would expect the stock market to react to that at some point, maybe 6 months later.
Now, when you were working many years ago on trying to develop the predictive powers or studying them of the yield curve, what notions did you have about inflation? Because that's really the special sauce here. You have a business cycle, Fed inflation growth become addressed, the Fed raises its rates, investors demand more or less based on inflation rates. Is the issue of global inflation being so tricky the last 10 years also a distortion? Your final thought?
Yes, inflation is very important, no doubt about it. It builds into the expectations that go into the interest rates. But one thing to bear in mind is that inflation is very much related to real activity. So, the biggest declines in inflation happen when we have recessions, basically. So the fact that, the rate may be lower because of inflation, that could be a recessionary signal in and of itself.